Everybody, welcome back to another video here on Financial Friends. Today, you are tuned in to another episode of the Dividend Journey, a journey where I am talking all about dividends. As you can see in front of you, I have my dividend portfolio, and I am taking you all through the journey of building that portfolio, giving you little tidbits of information and things I'm doing, thinking of, and making moves on here in the stock market, kind of educating as I also learn. That's really what this is all about. So if you're new to Financial Friends, come join the friend group. I am learning, I am teaching, I am showing, and we're all learning together. This is a judgment-free zone. Let's grow. Let's grow together. That is what Financial Friends is all about. So let's get into the video. First things first, we're going to take a look at the portfolio. I will try to leave a timestamp when the informational piece kind of happens if you want to skip to that. But first things first, here is the dividend portfolio. Let's go ahead and update the new positions, or not new positions, but the additions to the current positions that we do have. So first addition here was a $5 purchase of Waste Management, bumping this up to 2.86 shares with an average cost of $158.43. We're going to go ahead and save that. I want you to notice how the dividend, or the annual income rather, or dividend income goes up, as well as what it would go up for March. Unfortunately, we've already been paid out of some of these positions. And then yield on cost and dividend yield is affected too. So keep an eye on those as this goes on, because I'm not really going to be. So 0.243, we're going to go ahead and slide that over to 0.271 with an average cost of, unfortunately, it going up to 164.10. We're going to save that. We also made an addition to FizRocks. We're going to go ahead and edit this. Now, this is a relatively cheap position in terms of, just dollar value, not actual value. It's an inexpensive thing. It's 14 or like 15, 16 bucks a share. So average cost here is $15.96. Raised its annual income a cent. Okay, we'll take it. And we also did receive a dividend from O. That's going to bring our small position of 0.787 shares to 0.79 shares and a cost per share of $69.23. So we're going to go ahead and save that. So that brings our annual income up to over $11, which is nice. But notice the companies and the stocks that I have bought. Waste Management, a diversified index fund in FizRocks, Johnson & Johnson, and a dividend from our trusty old real estate play, O. Again, I've talked so many times about the companies that are in our portfolio. Apple, J&J, 3M, O, SCHD being an ETF, FizRocks being an index fund, and Waste Management. What do these companies have in common? I've talked about before how they're boring, but I want to talk about something different than that this time. I want to talk about how they are good, solid, stable businesses that you can understand. And the thing that I want to note here, the big thing, is businesses. These are businesses that are proven with profits and the way they operate. They're true businesses. People need their products, people want their products, people consume their products. Let's take a look at a couple examples of that don't necessarily have those same characteristics. First one being GameStop. Now, GameStop is a business. People do shop at GameStop. However, we can all see the inevitable downfall of this company and of this business. Take a look at Xbox Game Pass. Okay, what Microsoft's doing. Sony, again, they're producing consoles that don't even have DVD discs anymore. What's the need for GameStop in this current environment? Obviously, Nintendo Switch has certain things, right? I'm not necessarily writing GameStop off, but what I am saying is that GameStop is not necessarily a business that I look at as something to add to a dividend portfolio. Now, again, this is specific to a dividend portfolio. So if you're interested in making a quick dollar, or maybe riding this dip back up, or you think it's going to dip back down to here, so you're going to wait and you're going to buy more, whatever your strategy is, I'm not judging. That's perfectly fine. But what I am saying is that when you're building a dividend portfolio for income over the long term, you want to invest in businesses. I'm going to say that one more time. When you're building a dividend portfolio over the long term, you want to invest in businesses. Personally, AMC is not a company I want to be in long term. Now, first things first, these two do not pay dividends, okay? That's not necessarily the point I'm sharing. What I'm sharing is I don't believe in AMC long term. I don't think that AMC has a stable business model. They have movie theaters. Eventually, I can see movie theaters going out of business, going out of style. People are going to watch everything right from their home or right from their couch. That's my personal opinion. You might have a different opinion on that, and you might purchase the stock, and that's perfectly fine. I'm not bashing these two businesses. I'm not saying that they're terrible, but what I am saying is long term, they're not something that I want to be in. Now, you could see it in the thumbnail of this video, and I'm a little bit of a hypocrite because I own this business, okay? Rivian. Rivian IPO'd for $78 a share. It ran up right away to the 120s, super high, and it has dipped ever since because they aren't a good business at the moment. They could be in the future, but at this point in time, they are not a good business. They've made 1,200 vehicles. 1,200 vehicles. That is not a business, right? It is a business, and it is a good business, long-term, EV, innovative, right? I understand this. I'm not ignorant to that, but what I am saying is that long-term, buying right now, but focused on the long term, I don't know if this business makes it out of this whole EV craze. What I do know is 3M is going to continue to be a good business long term. They pay a good dividend, they make money, they profit, and they pay back a piece of those profits. That's what I like to see in a dividend portfolio in specific. Remember, this is all specific to dividends. However, this is a business that makes things that we all use. Where are they at? Where are they at? Right here. Boom. Post-it notes. Right behind me. Hung with 3M. Hung with 3M. Hung with 3M. The lights that aren't on, that normally are on above me, hung with 3M. Scotch. It's 3M, okay? Scotch double-sided tape. Boom. 3M. They also make masks. They make a ton of other products. I've shown their website before, and maybe I'll do it again in a future video. But this is a company that produces products and things that people and businesses and entities use. Johnson & Johnson. You take Motrin. You take, not Advil. Tylenol. We use Band-Aids. We use Johnson & Johnson consumable products. Now, this company will split, and all of their consumer sort of goods will go one way, and all their medical things and pharmaceuticals will go another way. But people use both sides of the business. They wouldn't be able to spin off into two separate businesses and all of a sudden continue to be successful, which is my guess that they will both continue to be successful, although the pharmaceutical side might be higher growth. Anyways, Johnson & Johnson, look at the run. Look at the absolute run that Johnson & Johnson has been on. And they have the flexibility and the optionality because they create products that people and businesses and consumers use to spin off the consumer health sort of side, right? Shampoos and Band-Aids, etc. I think even the Motrin and Tylenol are going to be included in that, and that's going to be its own business. And on the other end, you're going to have medical devices and true pharmaceutical, products like, pills and medications and such, not over the counter, that are going to be prescriptions that are going to be its own business because people use these products. It's good long term. They make money and they give it back. If you don't know which of these to buy or you don't feel like doing the research, invest in SCHD. We went over the holdings before, maybe a video linked up here on SCHD. Pepsi. I think 3M's mixed in there somewhere. Home Depot. All of these big companies that pay back. Pfizer. They're all involved in this. They all are profitable. They all do things that are profitable. And then we get chunks of the profit. And that's what a dividend portfolio is all about. Investing in businesses, not stocks. This, at one point, was, a business that people may have thought was going to do well and they believed in. This over here, right? Let's try and see if I can isolate it. This portion was a stock. It was not a business. People were not buying on fundamentals, holding long term because they believed in the business model. Now I have to go back to it. This was a stock, and clearly not necessarily the best one, right? And again, it's not just price that matters. This was people not buying on fundamentals. In my personal opinion, this is not investment advice. AMC is a business that long term will not do well. We are moving away from movie theaters. GameStop, we are moving away from discs inserted into our consoles. But this was buying based on, analytics and hype and shorts and trying to squeeze people. And for a solid, stable dividend portfolio, this is not what we are looking for. And again, I don't want you guys to take this video out of context. What I'm saying is not don't invest when it mathematically or technically makes sense. What I am saying is that if you're building a dividend portfolio for the long term, do not get caught up in buying stocks and chasing returns and chasing stocks. Buy businesses that make money, that consumers like, that companies like, reinvest their, some of their profits back into the business to grow and innovate, and give a portion of it back to you, the investor. So if you take anything away from this video, buy stocks, not buy businesses, not stocks. Thank you so much for watching this video. I hope that you learned something. I hope you enjoyed the video. If you made it all the way to the end, comment pancakes. And make sure that you tune in every week at the end of the week for This Week in Finance. I will see you all on Thursday. Have a great one.